Welcome to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors, and today we're diving into one of the biggest advantages in property investing: timing. Not just picking the right market, but getting there before everyone else. My guest today, Scott Aggett, is back on the show, and he specialises in identifying what he calls green shoots markets. These are locations showing early signs of growth, often 6 to 18 months ahead of the broader market. We unpack why buying early can mean better prices, less competition, and stronger negotiating power, and why chasing hotspots often does the opposite. We also get into the risks that don't get talked about enough: investor-heavy markets, off-market myths, and what happens when too many buyers pile into the same location. If you've ever wondered whether you're early or already too late, this episode will help you think about property cycles very differently. Here's Scott. Scott Aggett, welcome back to Geared for Growth.
Thanks, Mike. I love being on the show. Thanks for having me, mate.
Well, we love having you, and last time we went through an absolute negotiation masterclass. Now, of course, that is a skill set that puts you in high demand. You're training and teaching professionals in the real estate and the buyer's agency business. You've been negotiating with your own brand in the buyer's agency space. And of course, you are a buyer's agent that now has a national focus, putting people into boom locations. I want to talk to you about green shoots and identifying these opportunities. There you go. Anyone watching on YouTube's seen a little brand homage there. Because I'm witnessing a lot of unusual things where, you know, for the first time, first perhaps decade, we're seeing large volume buyers agents go into markets, and I fear for the people that are coming in there after that. And I know a big part of what you're doing is parking people in markets almost before they have those green shoots.
Yeah, I mean, if we look back over my 30 years working with investors, getting to these markets at an earlier stage has set these customers up really well if they can hold on for that entire growth stage. So when I launched this business, I wanted to focus on using the data to get to these markets typically 6 to 18 months ahead of the herd. When you do that, Mike, for my customers, I've got greater choice, I've got more motivated sellers, and I've got less buyer competition. And the three of those things allow me to turn the screw and negotiate harder. So I can buy better by getting to these markets at an earlier stage. And that's really important, because if you go into a hotspot market defined by, let's say, double-digit growth over the last 12 months, what you'll find is that almost every sale that's happening is setting a new suburb record. So you're going into uncharted territory. You don't have much negotiation power. You're competing against deep buyer pools that are chasing those same assets. And people that are on the ground don't want to sell right now because they can see the frenzy in the water. They can see property prices moving really quickly north. So you're only looking at a very small portion of ownership in any given suburb that's going to turn over in that sort of market condition. Change when you go into the green shoot markets, and a lot of the times the owners that are there don't have access to this data. They've just gone through a 3-year, 5-year flat period. They may have bought at the start of that period and gone into negative growth. And they want to get out of there. So they're looking for an exit. And that's the prime time to be buying those assets.
Yeah, and look, I would back you to be an expert negotiator in any market, but I would assume that in a hot market, if you and I were head-to-head fighting each other and I'm just prepared to pay more than you, it kind of removes a lot of your skill set, right?
Correct. Yep. There's not a lot of value that we can add if people are going to pay an emotional premium over the top. And what you'll find is that you're competing against mass market buyers agents that have got very transactional targets they need to hit. So putting another 10 grand, 20 grand, 30 grand where we may not see value on top of an offer is where we'll walk away. And unfortunately, those deals get done. So, you know, that is very difficult to negotiate around that. So the key in a hotspot market for us where we can add value is relationship building, understanding value very quickly and confidently to make a decision in a very short window, and normally buying those assets within the first 24 to 48 hours. So using leverage, really controlling our dialogue like that, and trying to find those motivated sellers. But for the points that I just referenced before, there's not that many motivated sellers in that market because they know that they're spending money on marketing to bring it to the public eye. The agents know that they just need a little bit of time in the sun. Might be one inspection or 2 inspections publicly, and then you've got a big buyer pool competing for these properties, and then in come those emotive offers, and the price just gets away from us. So it is difficult. You can move with speed, but it only takes you so far in a hot market.
Now we can look at totality figures and see that, Brisbane, Adelaide, Perth, Darwin has sort of had a really modest print for the first time in a long time, but we're seeing green shoots in the data from Tasmania. But I want to sort of challenge this idea about green shoots and when we actually see green shoots, because I've always kind of argued that if a market has a growth cycle of, let's just say, 20%, if you're seeing positive signs in the data, there might only be 15% of that left. How important do you think it is getting in there before it's actually able to be seen in some of these data points?
Yeah, that's an interesting way of framing it. So we're looking at both short-term and long-term supply and demand pressures. So a tightening of supply and an increase of buyer competition. Even at that very early stage, we can see that in the graphs. We're looking at major infrastructure. We're looking at population shifts and job creation. We're looking at affordability. We're looking at socioeconomic scores as well. So the ERSAD comes into play for us as well. And we can see at these markets that are just starting to show growth at a very early stage. So, we could look at a market like Hamilton, for example, in regional Victoria at the moment, which is just coming off a, 5-year period of underperformance, or 3 to 5 years. I haven't got it in front of me, but you can see now it's just starting to get into the positive territory in the last month, quarter, 2 quarters. So you can see very early that this is a market that has everything aligned nicely in terms of those metrics that I just said, but is just turned past midnight, if you like, and is just starting at that early stage of its next lap around the property clock. You take that versus somewhere like Williams Landing, where we've bought a lot of properties over the last 12 to 18 months in Victoria. We used the same methodology to get to that market at a much earlier stage. We had basically no buyer competition, or very little buyer competition, this time last year. Fast forward 12 months, that particular suburb is one of the most sought after suburbs or searched in Australia for professional buyers and buyers agencies. So that, we could see that there was the signs of that market moving, and then everyone else could see that those markets were moving. But it was going from, say, 0.1% a month growth. All of the markets we're buying in last month are doing more than 0.5% growth in the last 30 days or so. So you can see they're gaining momentum, and it's the right time to enter those markets.
So those clients now will love you. But at that point in time where that data wasn't necessarily there, it was like just a tiny little turn over the top of the downturn hill potentially. Do you struggle to try and convince people that it's not the markets that you're seeing already booming that the real value is? It's the ones that are right on the cusp because of that negotiation power and because of the full upside swing. Like, is that a hard thing to convince people that might be prejudiced about wanting to jump on a published hotspot that's already hit the media, or they've just got maybe a capital city bias? Like, how do you encounter those conversations?
Yeah, that's a good question. I think the most important thing that overrides all of this is it's horses for courses, right? It depends on your existing portfolio, what your financial goals are, what your risk profile is. So it's very much bespoke to the client's individual budget and their overarching goals and their position. Then we would talk about any natural bias that they've got in terms of any particular location they want to be in, or where they've got exposure to already that they don't want to be in. There's a lot, for example, that don't want to be in the higher stamp duty, higher land tax, tighter rental reforms in Victoria, for example, that we would discuss. But when we look at it from a growth stage perspective, and what I do at the very start, once I've established all that information with the client, is I'll show them, I'll take them behind the curtain and show them how we filter through those suburbs. And part of that is looking at where these suburbs are in the growth rate or growth stage. And, we referenced before markets like Queensland or South Australia and even WA to a certain degree that are already a long way through that big growth cycle. So where I am, for example, in Miami on the Gold Coast today, we bought here a few years ago, but it's done 10 years of double-digit growth. It's sitting at 175% house price growth. What would have been a much more affordable market where it had investors and owner-occupiers, and you want both those cohorts competing to drive the prices up, is now a market that takes 89 years for the typical person to pay off the typical loan. So gone are the investors in that market, and now you're dealing with a more premium, mature, blue-chip suburb, pretty much only restricted to owner-occupiers. So we're looking at those markets and we're saying, okay, great, well, Queensland basically is all in a decreasing growth cycle. Doesn't mean you can't make money in a decreasing growth cycle. Doesn't mean Queensland's not going to continue to grow and be a fantastic place to invest. It's just getting closer to an affordability ceiling because it's had so much growth in that last decade. It can't keep growing naturally at that price point. Same with Adelaide, same with much of South Australia, and very much similar in Western Australia, as I referenced. So when we're showing those growth stages to the clients, it becomes very obvious that if you want to get in at a green shoot early market, well, then there's certain areas in Australia that may have missed the last growth cycle or just had a smaller increase in that period, and now they're poised to grow again, start to grow again. It might be a second surge, if you like, or it might be markets that are just due to play catch up. There's a multitude of different reasons why those markets may increase or those suburbs may increase. So we really focused on where it is within the growth stage as well. And you referenced there Tasmania. That's definitely a market that we've been looking into for the last 3 to 6 months, and it's very active for multiple buyers agents that probably have a similar view to what we do. But I think it's also important that if the data in any particular suburb is still really strong, well, then there's no reason not to buy there. Williams Landing is a good example. Yes, there's a lot more competition there. However, the fundamentals are still the same. Like it looks really good from a supply-demand perspective. When you look in Wyndham LGA within the surrounding suburbs in that council area, it has the highest infrastructure spend per capita as well. So you're talking about, the average infrastructure spend might be $100 to $200 per person across the country in most suburbs, or the average suburb. In Williams Landing, it's a completely built-out suburb. There's no supply risk. It's less than 20 years old, so all the infrastructure is nice and new. There's no developer stock. They're not going to find a cow paddock to create 200 house and land packages tomorrow. But there's $13,800 infrastructure spend per capita there. So that means what is already a highly desirable location is only going to get better. We think more desirable for people to want to move into that suburb, and it's going to continue to gentrify for those people that live there. That means upgrades to things like train stations, bike paths, open spaces. So that's not a reason to leave because it's already gone into a peak market cycle, even though it's only early in that stage. But if the fundamentals still look good, then we would still happily buy there if it's the right fit for the customer.
Awesome. One thing that you mentioned that I wanted to pick up is the owner-occ versus investor appeal and the percentage, right? There's markets that are very, very closed off to investors because normally it's a price point thing, and then the other ones that are really oversupplied by investors. And that's not necessarily a problem, other than what we observe in the data is that we want more owner-occupier people to be competing for those houses because they're more emotional and they're probably 2/3 of the buyer pool. So if you're just attracting 1/3 of the buyer pool, how much competition can you pack in that drives up the price? One thing that we see in our data as well is that we know that people that buy an investment property and they live in it, not only are more likely to make improvements or renovate the property, but when they are both doing it side by side, the owner-occs spend more money. So it kind of improves the overall suburbs. It gentrifies, the street and the streetscape. There's more likely to be a buzz and things happening. And it leads me to the question of when we're seeing large volume buyers agents in Australia that didn't really exist in the same way 10 or 20 years ago, moving into markets, how much do you think the consumer understands that just these seas of people going into these places could really be a self-fulfilling prophecy where they're artificially increasing that demand because of the investors going in?
Yeah, it's a big concern for us, and I know you and I have spoken about this previously, just from an industry-wide perspective, that it's very difficult to ascertain what the latest data is in terms of that ownership split. So, for example, in Williams Landing, as a talking point, there's 39% investor ownership, which is just on the cusp there of where I'm comfortable. We have our sort of our metrics set at sub 40%, and the closer you get to the the ideal sweet spot of 15% or less ownership is ideal. But the problem in the data for me is that when you've got, let's say, and I don't know the specific answer to this, Mike, but there'd be at least 30, possibly 50 major buyers agencies in Australia, and I'm talking businesses, not individuals, that are doing north of 50 transactions a month. And many of these are doing north of 100 transactions a month. So if they're going into identify a suburb like that, then it's going to be a period of lag before we can tell that it's 39% or is it now 46%, and it's gone over that threshold in terms of investor ownership because there's just so much traffic going in there. That's the danger for me. The other big thing for me is when you see a lot of marketing for the newer buyers agencies in the industries and the award-winning buyers agencies, there's a real push in their marketing for off-market deals. And you'll see a lot of references to 75%, 85%, 95%, whatever the bullshit number is that's made up. Hopefully it's made up. Is a concern for us because, as you know my background, 23 years sitting with the real estate agent hat on, there's just no way I'm motivated as a real estate agent to sell to anybody off market unless I've got a very motivated seller. And that might make up 15% of the total seller pool. And that's because someone's inexperienced, sick, under financial pressure, bought already and need to sell. Whatever the reason is, it makes up about 15% on average. And that's in line with our percentage of off-market deals that we do. But that means 85% of the good property is going to come on the market and have competition. So when buyers agents market that they're transacting in huge volumes off market, what it's saying to me is that the new norm is that we're prepared as Australians to overpay for these opportunities. And to your point that you referenced, it's like, how many of these investors are going into these markets? They're then overpaying, and they're going to end up in an area that's saturated with like-for-like investors, which means potentially increases in crime rates, less desirable properties because they're not cared for. So the streetscape is just not as attractive as what it may have been otherwise. It brings liquidity issues into the market that may not have been there previously. There's a lot, faster turnover for investors than the long-term traditional owner occupiers that are there. So it brings with it a host of different issues that we need to be concerned about.
Devil's advocate hat on now, and I'm going to throw you some chin music. You've got it all wrong, Aggett. You just haven't put the time in to develop the strength of relationships with the local agents that these volume buyers agents have done.
Yeah, that's a good counter argument. So I'd say there's the first reason, which is you're overpaying to get those opportunities. The second reason why real estate agents might throw you a bone in that instance off market is because you're guaranteeing them the rental back as a property management, right? So they don't want to lose a management, because when I owned my real estate agencies in Sydney, the golden handshake mic at the end when you sell, because the business is worthless if you leave as a lead person in the business, or I can't remember the term I was about to use there, key person of influence in the business. The value is in the rent roll, right? So if you're going to destroy your rent roll to sell these properties off market, all you're doing is, reducing your golden handshake at the end when you sell that asset and sail off into the sunset and retire. So if you're guaranteeing them, a buyer's agent, a listing, they're going to give it back to you, then that is also a problem as well, because you're dealing with any buyer's agent. You're dealing with any real estate agency. They're going to supply you these leads. Are they the best person to be managing that asset long term? Who knows? So that could be the other reason why they're getting a lot of opportunities. But it's fundamentally flawed and it's common sense. Like, if you're a real estate agent, you have to list and last. You need that time in the sun to build your profile. As the market moves towards AI and digital disruption, agents are going to need to be out publicly showing what they do to add value in the process. Otherwise, why do we need real estate agents? So they're really going to cut their nose off to spite their face. If they're going to sell all their stock off market, it's not going to end well for the real estate agents. So I think it just leads straight back to the only reason they're doing that is because they're getting stupid high prices and they're being very transactional. It's easy for them to do a lot of volume, make a lot of commission, because they've got a lot of suckers in the form of buyers agents that don't care. They're transactional. Yeah,
look, I'm going to dump my devil's advocate hat because I didn't believe in it to begin with. But, for the sort of the point of balance of the show, I guess I'm just kind of thinking, like, why would a real estate agent want to be besties with someone like you? They don't do things out of the goodness of their heart. I mean, they shouldn't. Their job is to get the best result for the vendor, and they want less friction, right? Because if you're getting 2% of the listing fee, you don't want to spend 120 days on it. You want to spend 10 days if you can, right? The best way to spend 10 instead of 120 is have a buyer's agent that is prepared to pay probably more than you could potentially get it on that open market. I mean, am I being too unkind, or is that really more the reality?
The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
It's the facts. And I'll debate it till the cows come home because I sat in that chair and did over 4,000 transactions in 23 years. I know how the market works. I know the psychology of it from the agent side and also from the buy side. And Mike, it's the key reason why I went and built Hello House, which I did for 7 years before Green Shoots Property, which is the negotiation as a service business that I created. And it was because I sat in that agent chair and I watched the rise of buyer's agent in Sydney. This was going back in 2014, 2015. And they would just be in a rush to pay a premium with a cherry on top. And, if that suited me to sell it off market because I had a vendor that didn't want to go and pay for marketing costs, they were private, they didn't want to open for inspections, they were in a hurry to sell for whatever that reason, I would take that premium with a cherry on top. But otherwise, I'm never going to do that because I know that that's a lost opportunity where I'm not going to meet 100 buyers in the marketplace. I'm not going to meet all the neighbours. I'm not going to have a chance to show the value of my service and negotiation skills at a live public auction forum. So these are all very straightforward reasons why it's the biggest furphy in Australian real estate. Off market is a furphy. Yeah. So, there's a very small element of it that is correct, which I reckon sits at 15% of the market that turns over for the reasons I mentioned earlier. The rest of it is buyer's agents that are lazy and deliberately overpaying.
I wonder if we can approach it from a slightly different angle. I mean, my head always goes to the consumer. Like, why would I care if buyer's agents are overpaying? Well, I care about the consumer, right? Why would I care if there's so many off markets? Because there's a real risk that they're overpaying and might be, left out to dry. I think it's hard to see it now because so many markets are growing. I mean, we're sitting at just under 10% national growth rate in the last 12 months. So you can sort of overpay and be okay in the short term, maybe even overpay and think your buyer's agent is a legend and give them a 5-star review. But in a decade's time, we might be sort of seeing something different. But let's just say, I've had so many people tell me that I should be a buyer's agent. I've got enough trouble doing what I do, right? But let's just say because I'm so charming, people come to me in my new buyer's agency that I set up today, and I have suddenly 100 people that I need to find things for. How are the buyer's agents placing 100 clients into these markets and justifying that, this is something that we can hang our hat on to say we found you the best property that we possibly could in Australia with that conflict of volume in the mix?
Well, I think the way that it's been set up that I can see from sort of the big volume driven buyers agents is that we're going to guarantee you, extreme growth. So they're putting you into markets that are doing 8% plus. They're outperforming the Australian long-term average of 6%. And you see it even in their marketing, like there's guarantees that will outperform the Australian average in the first year or your money back. So they're buying into markets that they know are in hot demand. If they overpay by 10, 20, 30 grand, it's irrelevant in the grand scheme of things for them in their model because they'll make that up really quickly in terms of capital growth. But they're still overpaying for those properties. So I would argue with you, your first point there about, what's it matter if I overpay a little bit? Well, that money compounds, right? So if you waste 10 grand or 30 grand or 50 grand, it's a hell of a lot of money when you pay that off over a 20-year, 30-year period, right? It just keeps compounding. So I think, from the statistics that we looked at when we were doing the previous business, Hello House, so I had 50 grand per $1 million being spent that Australians were wasting. They were overpaying, right. They were losing money on chasing down the wrong rabbit holes in terms of spending money on conveyances, building and pest reports where they had no chance to buy those properties. So, really expert analysis and negotiation is going to save you money. It's also going to save you a lot of time. The average person transacts in 10.1 months in Australia. Our average client transacts in 3 to 6 weeks. That's not a badge of honor in terms of speed. We never use that as a marketing win in terms of how fast they buy in that regard. But when you're working with a professional who understands, where the price is right or where it's wrong, you can quickly stop chasing assets that you've got no chance on, and then you can quickly secure the right asset, and that makes a big dent in that time. The danger for me in terms of being transactional is that if you're buying these properties in these hotspot locations and that's the goal for the customer. That's fine. Many of our customers want to do the same thing. They want to leverage into these assets and grow as quickly as they can. There's nothing wrong with that at all. But it's more a case of they getting the right advice of when they're going to have to exit those markets. And Darwin would be a good example. Like we can show you quick growth, we can show you strong rental yields, but can we show you a history of consistent growth? No, we can't. Because if you look historically in those charts, it's like this, right? It's a very volatile market. So it's really easy for me if I was a transactional buyer's agent to say, great, let's go and buy 100 properties for people in Darwin last month. They're all going to be up, 1% this month, and they're going to be flying. They're going to get to the position where I can charge you a second fee really quickly, right? So I've got you twice. But then am I going to get you out of that property in 3 years' time or 2 years' time and time it perfectly that you don't end up with egg on your face? I got my fees out of it, but then are you going to be in a negative position in 5 years' time or 7 years' time? I don't see enough of that advice later that scares me, because I see a lot of customers that come to us and say, I made a mistake and bought in whoop whoop from, a buyer's agent 7 years ago, and it's seen, it saw quick growth and then it's just been flat ever since. It's a dog shit asset and now I need to get rid of it. And no one has been in contact with me about getting rid of it. They're all just trying to sell me another property.
Do you think there's a bit of an issue with the fact that we've got? I've had conversations with buyers agents that have talked to their client and they're like, oh, that's great. The first 12 months we got you, 10% growth, which used to be amazing. It used to be like something to hang your hat on. But then people will come back to them and say, oh, well, you missed Darwin, or you missed Perth, or you missed Townsville, because there's always potentially somewhere that's done 15% or 20%. But the buyer's agent's making the decision, well, sure, that did better in 12 months, but I don't believe in it outside of that. Do you think that property investors in general have become a little bit more impatient and they almost demand double-digit 12-month rather than thinking about the long-term fundamentals? Because I haven't seen the data, but I assume that, we're not now holding investment properties for a quarter of the time that we used to. Most investors will hold them 10 years plus, right?
Yeah, but I think there's a huge wave of new thinking around this from the well-marketed buyers agencies that focus on, short-term growth and a sprint to hit your goals, and turning over property like that in a shorter time frame. So getting the wave in each of these growth cycles and exiting at a certain point. I just am concerned about how many of those people are getting the right advice as to when to exit, and then the customers that have got enough confidence to make those decisions. Because, I've got a good one that's an example now. We bought 2.5 years ago in Greenfields in WA, which is south of Perth. It's a one URSAD location. It had pretty poor performance for the 10 and 20 years that came before it. There was no indication that market was going to do what it did. It was certainly all aligned in terms of the data for it to see some significant growth, but no one could have predicted what it's done. That market I bought for $600,000 for a client, a duplex pair, untouched. I've got a valuation on it last month for $1.5 million. So 150% growth, $900,000 equity in 2.5 years untouched. Now, I rang that client, who's a really great client of mine. I've bought 4 or 5 properties for him, and I said, you need to sell that asset. And he said, why would I sell the golden goose that keeps on giving? Like, it's positively geared. This thing shits cash. I made a fortune. You've changed my life with this property. There's no way I'm selling it. I said, okay, great. Well, look at the graphs now compared to what I showed you 2 years ago, right? Now we're in a stage where it's beyond an affordability ceiling, right? Like it's out of whack there. There's going to be no real investors that are racing to buy into that market. The owner-occupiers that are there are now priced out of that market. They can't afford for future growth. And then historically, if you look at it, we just haven't seen a spike like this. So the risk is the spike's going to be next going down, or at least it's going to be a long plateau. So that's a point where I want to educate the client and say, we had this discussion up front. We'll make the most of it for however long that run is. But then we've got to look at it through a different set of lens or thinking, and then de-risk that investment. So that might be a sell down, reallocate that capital and go again. So there is markets like that can do incredibly well in a short time, but you've just got to work out when you're going to exit out of those markets as well. And that has to be your strategy. It's, so the vast majority of my clients don't want that. They don't want the stress of that. They'd like to see those returns, but they're also smart enough to realize that to de-risk it, they buy in a market that has got a little bit more maturity, definitely a higher socioeconomic demographic that's on the ground, and the capacity for those rents and capital values to increase over time, but do so consistently without the volatility.
I love that observation that the place shits cash. I've never heard that one before. But I wonder with that conversation, and maybe this is some sort of bias that we have, we buy an investment property, and if you're buying anything today, it's fair to say it's going to be negatively geared. There's very few times where, you point at something at random, then it's going to be a positively geared property in, the history of property in Australia. But once we get to a situation where that property is paying for itself, or it's actually putting money in your pocket, do you feel like there's a reluctance to get rid of that, even knowing that the potential upside of the capital growth and where they've made the most net position is not necessarily there in the future?
Yeah, it's an interesting conversation to have with people, because that client in particular, it's going to be a hard decision for him for those very reasons, right? Like, he's made a lot of money on paper, but I guess it's de-risking it, as I referenced, and protecting that equity that you've built, and then reallocating that capital into a market that could potentially, perform at a more consistent rate and set them up long term for the future, and just more of a blue chip asset than a higher risk one. So horses for courses again. Each client's going to take that differently. But yes, I could see why people would be sitting there going, well, it's washing its own face and it's done what it needed to do. Whether it did it over 2.5 years or 20 years, it's still done it. So it's an asset that I'm happy to hold on, and I'll wait for its second wind whenever that might be. The other thing that I was going to reference in the previous question that you mentioned that is a bit of a danger, I've tried to fight myself doing this publicly because it's just such an easy trap to fall into. But in my industry, on the buyer's agent side, it has become a pissing comp in terms of, showing how much money all these clients made and drawing clients to the surface on the proviso of these huge numbers that we can hit. Like, it's very easy to get a CBA bank valuation at the moment, for example, that is going to show an overinflated property value, not necessarily what it's worth on the open market. And we can show you extreme growth. And that's what's bringing all these people in that want those outcomes very quickly. So we're really changing, like the last 2 or 3 years or 5 years has changed the way that Australians have invested. And it's going to continue to change that way, because this is where all the marketing's heading as well.
Yeah, look, you're seeing that everywhere. Like, if you have Facebook, you will have seen that. Bought for this, just got the desktop drive-by bank val, which
up 400% in 2 months.
Yeah. It's another thing to then put that property on the market, pay the capital gains tax, pay the selling fees, and then figure out what your actual net position is. But people, see, that's where again it comes back to the consumer. You can't. Like, I think professionals like us sometimes kind of think of the consumer, why can't you see through that? But I don't think people that are doing it every day can see through it, and they probably shouldn't be required to, right? They should be able to transact in an industry where people are making reasonable, verifiable statements, right? But you're seeing the same thing that I'm seeing, that there's just a lot of promises out there.
Yeah, well, I mean, it's so heavily regulated in the finance industry, isn't it, that you can't talk about those outliers. You've got to talk about, the general performance of the fund over many years, and you've got to say, future performance is not guaranteed, and blah, blah, blah. And none of that exists in our industry. So you've just got a whole heap of people that are going to lean into that really hard, because it's an easy thing to do, right? And if you can show it on paper, then it's true. Like, I've got a bank valuation that says that property is worth 1.5 million. It's from the biggest bank in the country. So it's factually correct that it's worth 1.5 million. But as you've just alluded to, the commercial reality on market value is going to be vastly different to that number. So it is hard. Like, I guess the guardrails like that exist in other industries just aren't there currently in the buyer's agent space. So that allows a pretty loose set of marketing parameters that we live and die by at the moment on Instagram, Facebook, and TikTok. And people shouldn't be expected to be able to read through that, because they don't do that for a living every day. My concern is, though, that you suck people in with those numbers, and either they don't hit those same outcomes, or they're not educated along the way as to when they need to exit, like the downside risks of those amazing bull runs. That's a concern for me. Yeah, and you've just got, the other big thing to put into account is the numbers that they're charging these customers to transact. It's incredibly profitable to run a very successful buyer's agent if it's transactional. So they're motivated from the wrong viewpoint, I think, as well. Like, they might be running at 60, 70% profit on these deals. So they might be charging $30,000, $40,000, $50,000 for these transactions, but they don't need to be. So it's in their best interest to just do a huge amount of volume. So that's why we're seeing it, because, you cannot open or follow a buyer's agent on Instagram or Facebook without seeing the fast cars, the private jets, the global holidays, first class, or very expensive holiday destinations, the huge portfolios that they talk about, they build themselves, and you're paying for it. Yeah. So I'd like to see an advertising campaign that kind of, checks out my Rolex and says, that's from Mary that we just overpaid in Ballarat. And, this, that Ferrari, well, that's Uncle Frank that bought for me in Darwin. He bought 6 times in 2 weeks from us. I'd like to see a little bit of reality come back to some of these marketing campaigns.
I wouldn't hold my breath, mate. I want to talk about where we are at the space in time, March 2026. We've got a few things in the news right now, but before we jump into that, is there anything else you think the consumers need to know or understand about the buyer's agent space right now to be able to protect themselves and to get what can still be a fantastic result without being promised the world and then having the back end concern about maybe an asset that's going to do nothing for 10 years or really needs to be exited, but they're not having that after sales support?
I think for me, the biggest part is strategy, Mike, like just making sure that the strategy is bespoke to whatever your specific needs are. Because the issue with being transactional is becomes cookie cutter advice, right? Like if everyone's buying in Ballarat next month because we need to do 100 of them and make it nice and easy for my business, well then, is that the right fit for Mike Mortlock and his family? Is that the right fit for Scott Aggett and his family? And possibly it's not, based on what else you own, what you earn, what your borrowing capacity is, what your risk profile is. So I think strategy is a really big thing that most inexperienced buyers may not really understand how important that is. 80% of the value of that asset over time is going to be in the location that you put it in. So if you're going to go buy the unit around the corner from you because it's easy, well, then you're going to give up on potentially, a huge portion of capital growth. So that's an important part of it, but you've got to get the strategy piece right before that. Understand why you're buying in a particular vehicle, whether it be a trust or, self-managed super fund or in your private name. Understand all of those things, understand why you're entering into a market at a particular time, how it's performed and what its future projected performance might be. And that'll give you a lot more confidence, I think, to protect whatever decision you make next.
Sagely advice there, mate. Now, to the situation that we have at the moment, war in the Middle East, people filling up their wheelie bins with petrol. We've got the May budget fast approaching, with Labor having, a lot of power, potential reform to CGT, potential negative gearing, a lot of pundits and inside leaked information saying it's a force majeure in a lot of ways. How much do you care about the noise of the particular moment in time? Because I'm always struck by looking out at the 20, 30, 50-year time frame of property and things like GFC, a tiny little blips. Or do you think we need to understand it just because maybe the market does overreact in the short term and settle in the long term? I'm keen to hear your thoughts on the macro space.
Yeah, well, it's another reason why I focus on the markets that are early stage in terms of their growth cycle, because my clients want to make long-term holding decisions, not short-term decisions. So I pay less attention to the headlines in that regard and what's happening globally, because my clients are de-risking it by holding those assets that they buy at the right stage to enter that market. So we really lean into more so those metrics that we talked about before, about affordability, socioeconomics, supply and demand, the typical years to own those properties. And we make sure that we're buying in markets that we can hold in long term, where there's a lot of room for the people that live there to pay those higher rents and higher prices. And then we hold on for dear life. So we're not really thinking short term with that. I've got many clients that will come to me, some of which even in the last 3 months, that have wanted us to debate who's going to win the next election in any particular state and how that's going to impact property prices. It's like, you just got no control over these things. I've got no control over, Trump bombing Iran and maybe getting away from the Epstein files, or what's happening somewhere else. The capital gains one that you referenced with Labor. I mean, I'm old enough to have remembered this, every 2 years, that it's a major discussion in Australia. So they may do it, they may not. It's out of your control and my control anyway. So fundamentally, can you afford to buy within your financial means and hold long term? And should we focus on the right metrics to ensure that this market's going to perform as best it can going forward? And can we project at a very reasonable rate of 6%, which is the long-term average, rather than hypothetical 10 or 12% to entice you to make a buying decision? So we're very conservative by nature with our rental estimates, conservative by nature with our future projections on price, and we just try to make very sound financial decisions and not push it too hard. But we aggressively want to outperform the market as best we can. So we've got to balance those two things. We're not looking for mediocre performance. We're just looking to de-risk it at every stage we possibly can.
Yeah, I'm just struck by the fact that you're conservative by nature in every way, yet more radical look. You've always had great hair. You've got rock and roll glasses. That's your outlook for being crazy, right? But real estate, it's the fundamentals. It's the conservative. It strikes me how often that I interview experts like yourself, and the advice is actually really simple. It's not like a shortcut. It's not, there's a secret hack. It's actually you just need to get a quality asset, not overpay, have a good mix of owner occupier and an investor, and understand the demographics, understand the growth drivers, the jobs, affordability, population, all of those things, and be patient, right?
Yep, we just call it vanilla set and forget investing, and that resonates with 90% of the customers that I speak to. They, and the reason I called it green shoots is because I sat there at the start all of last year talking to my clients and saying, look, are you looking to manufacture equity, like through a renovation or a granny flat or a subdivision? So you fit in that bucket. Are you looking to extract equity, in the quickest possible time frame and grow a portfolio aggressively? That's your bucket. Or are you looking to enter into markets and de-risk it at the early stage of growth, hold on to those quality assets long term? And I said, and that's what I refer to as investing in green shoots markets. 90% of my customers, the hand went up, and straight away they'd say, I identify with that green shoot methodology. And it was a really easy decision for me to say, do you know what? I may as well call the business that, because this is what naturally I say to the customers, and it's what they resonate with, really easily. So yeah, there's a great comfort level with that. But it is very boring, set and forget. We're looking for low capital expenditure risk homes. And I think it's just a safe way to invest like that. And some of our clients that want to aggressively go after it, if it's the right profile, then we help them do that as well. So we can solve all the problems. It's just that the vast majority of our clients are really focused on those green shoot properties.
Well, mate, I love it. I think there's so much for people to unpack on that. Lots of really good fundamentals and some advice that will have you in good stead, not just in 2026, but in the future as well. Thank you for coming back on the show. We always love to have you.
Thanks, Mike. Anytime.
Cheers, mate.